Hello friends, welcome to the new year 2025. It's going to be a very exciting year. Now, what's going to be new in 2025? You're going to have high frequency traders or HFT trading desks, algo based traders, artificial intelligence based prop desks coming in from Western nations competing with us in our market for very high paced trading action. SEBI is contemplating allowing algo trading to retail traders in a commercial manner. They've asked for feedback on their website, and very soon, an average retail guy, provided he can lay his hands on good technology at affordable prices, should be able to take part in algo trading, which admittedly is not everybody's cup of tea. And you're going to have to compete not only with high technology, deeper pocketed people, but there are regulatory changes. The FNO index lot sizes are higher, they are bigger. That means you need more margin, you need more capital. I've made a video far before SEBI kind of tweaked the rules about FNO lot sizes. And in that video, I told you, do not even think about trading for a living unless you have a bare minimum of 25 lakh rupees, although 50 lakh rupees would be a lot more comfortable. But do remember, this was before FNO lot sizes were raised. You will probably need a little more money than that. So the tools that you used in 2024 or prior are not likely to work in 2025. It is in your interest to skill up, to gear up for the new age market that is coming your way. This is precisely what this video is all about. Now friends, let's do a very quick recap of the video that I made of what I expect in 2024, which I made in the end of 2023. I told you that there were elections in 5 dozen countries and the economic data would be massaged. It would be gravy dressed in these 5 dozen countries, and almost 50% of the human population was electing leaders. So there would be a feel good factor. Markets would be artificially kept higher. All that happened. I told you that oil and gas will remain down, as would metals, and that too there would be no super cycle in these two asset classes. And hey, that's precisely what happened. I've been warning you since October 2021 that cost of funds would go higher, and that is precisely what happened. In spite of the fact that noises were made about rate cuts, the cost of funds, the actual cost of funds, remains higher. Inflation also remains sticky, and I've been laughing at the idea that inflation was transitory. And guess what? The mainstream research community is now coming around to veering to that point of view itself. I told you in my videos that Bullion would basically see its days under the sun. It would come back into the limelight, both gold and silver. That's precisely what happened. Every video that I have to tell you something connected to this video is listed in the pinned comment below this video and in the description below. So please do make it a point to spend a few hours to gear up for 2025. I assure you, you have my word, it will be time well spent. Now, the bond markets are basically telling you that the rally in bullion is far from done and dusted. There's still more to come, and I'm going to cover that in this video. Interest rate sensitive stocks, which I have been telling you, are underperforming. I put out a special editorial write-up in my free Telegram channel. Hey, that's the only place, a social media platform, where I can upload tick by tick data in Microsoft Excel compatible files. I can put up graphics, I can put PDF files, etc. No other social media platform allows me this flexibility of uploads. So do connect with me on my Telegram channel. That's where I put up all the work that we do. So interest rate sensitive stocks, I told you, would underperform, and sure enough, the nervousness was very, very palpable. Now look at the chart on your screen. It's the Nifty daily chart, and it's on the spot segment. I've deliberately taken the period after 4th of June. Tell me what you see here. As a real world trader, if you're somebody sitting on the sidelines, you will say, okay, the market fell. It fell very sharply, almost at least once every month, if not twice in many months. But hey, it recovered. You and I, as real world traders, would know that every time the market fell, especially the way it did on 4th of June, where some stocks even fell 15 and 24%, mark to market payouts are a problem. Many retail guys got chopped out of their trades and they haven't yet come back in their older form, which is why MWPL is not rising. Now, for what worries me most, and this is something, please pay a special attention. I have been pleading, I've been pushing, I've been goading and forcing you to familiarize yourself with Dick's Token's work, who I believe is a master of the cost of funds narrative, cost of funds concept. Look at the chart on your screen. Now, this is a monthly chart of A, the Nifty, and then thereafter B, the Bank Nifty. What does it tell you? I have taken the peaks made in October 2021. If you ask me, Vijay, why October 2021? Hey, do remember that I started putting up posts on my social media accounts that you should be switching to bonds and you should start laddering them. From October 2021, I told you that cost of funds is going to rise over the coming quarters. So now tell me, the text on both these charts, the Nifty and the Bank Nifty, has a message for you. As a real world trader, I'm not talking of a non-market participating expert who's always bullish. They're always bullish. But then tell me, in the months that I have mentioned in the text, if you calculate the cost of carry, I'm not talking of cost of funds now, I'm talking of cost of carry. Squaring up the trade in the expiring month, rolling it forward to the next month at a higher price, where your cost of acquisition goes up. You pay brokerage, GST, exchange turnover tax, stamp duty, SEBI transaction cost, etc. Now, these execution costs are very easily in the vicinity of 1% a month. Now, let's also take the cost of funds. You are deep in underwater, my friend. You are in a loss if you're holding long positions on the headline indices. Ditto for these ETFs if you were to plainly calculate the cost of funds at 1% per month. Very reasonable. So, this is a worry that I have for the year 2025. I expect the cost of funds to remain elevated. Friends, this is part 1 of the video. I will be making another video because I'm not likely to be done in just one video. In this options special videos, I told you, in a market where cost of funds is rising, you are better off being a seller both of options and of futures, or maybe a combination thereof, rather than a buyer. If your asset prices are rising slower than the cost of funds, the bull is at a severe disadvantage. It's pure mathematics, plain and simple. You don't need to be a rocket scientist to understand that. Friends, a bit about what I will cover in my videos, because I am bound by certain limitations that have been imposed by our market regulator, Securities and Exchange Board of India. Even though I am a SEBI certified research analyst, there are certain limitations, like SEBI does not look kindly at screenshots that are provided by traders. And you would see that in the judgment against Abhishek Kumar Singh of Supreme Invest Trade. I can't even give you the screenshot of a recently concluded trade unless I have concluded that trade at least 90 days before I put up the screenshot and the result of that trade. I can't even discuss what I did for 90 days. Now, these are limitations which are in the law of the land, and I would like to, out of sheer respect for the law of the land, not cross these lines. And do remember, I am not providing any commercial services, so I would not want to get involved in any compliance issues where I am basically spending time, effort and money in trying to reach out to my online family out of sheer labor of love and then also getting penalized for it. But I assure you that I will give you the kind of ideas that non-real world traders cannot basically give you. I will stick to my same old usual game plan of mentioning sectors, of mentioning trends, of strategic rather than individual specific stocks or individual specific futures and option trades. I will give you enough idea to be profitable in 2025. Remain assured there. Now, let's take a look at the big picture. Inflation will either rise or will rise along with shrinkflation. Now, inflation is when cost of goods and services go up. Shrinkflation is when the cost of goods and services may not go up, but the quantity is reduced. This is what restaurant people do. This is what Parle G has announced. This is what Hindustan Unilever has announced. It is likely to become the norm of the day. Now, inflation may not be reported very accurately. This is a standard practice around the world. This is not a political statement. Please keep me out of political controversies. Now, why is inflation not reported accurately enough? Because, hey, inflation is not something that people like. As a matter of fact, Austrian School of Economic Thought experts believe inflation is also known as the misery index. You really think people want to tell you that your misery index is rising? I don't think so. Plus, nothing happens in financial markets without a reason, and because we are talking finance, the reason is also financial. Your income tax or wealth tax or long-term capital gain tax that you pay across the world in many geographies is inflation indexed. Now, it is in every government's favor to understate the inflation so that your inflation indexing protection is reduced and your tax liability is raised. If everybody was to give you the actual street level inflation, believe me, the amount of tax collections of governments world over would come down substantially. I don't think that's happening very anytime soon. Now, I expect the currency to be a volatile with a weak bias. I've written an editorial in my free Telegram channel. You can please read that. Also, I've made a video about what you should be expecting now that the rupee has breached the 86 level versus the USD. Now, since the rupee is weaker, you will see imported inflation. The landed price of goods and services imported from abroad will command a higher price and it will make inflation even more accelerated. Everything from computers, cell phones, television sets, medicines, pulses, edible oils, grains, vegetables, milk will get more expensive. Hey, fuel is a multiplier commodity. If the landed cost of fuel is going to rise, everything will go up because of transportation costs and other costs. Simple mathematics. Now, if you're a non-vegetarian, I think you will basically experience prices of poultry, prices of eggs, seafood, etc., rising at a very fast clip, basically unavoidable. So possibly even your electricity bill will rise at some point in time in some states in 2025. Do remember, it costs fuel to generate electricity, and if fuel landed prices are going to be higher, there's no way you're going to get away with subsidies, unlimited and perpetual in nature. Now, in this segment, I want to talk to you about something that many of you may not initially understand and may even question me as to why I'm discussing. But believe me, I never talk anything out of context or unnecessarily. Now, this is something that I do as a regular practice. I try to save money and I try to take away all my worries at the beginning of the year so that my attention is remaining focused on the job at hand. What is my job at hand? I'm a trader first, foremost, and always. I'm a doer of deeds. As a promoter of a prop trading company, I have to see to it that I put food on the table for my family, and I can't be worrying about unpaid bills. Do remember what Muhammad Ali used to say very, very frequently. It is not the height of the mountain that deters the mountain climber. It is the small pebble in the shoe which can stop you from climbing the mountain. If you are a serious trader, if you trade for a living, it is in your interest to remove all the worries from your mind about your day to day living so that you can focus 100% of your energy in trading the markets. So, what I do is I try to prepay as many things that I can. I had a near brush with bankruptcy in the crash of year 2000. It's something I've spoken about, written in my columns, talked on television in my studio interviews very, very openly. I learned a few lessons after defaulting on my insurance premiums, after defaulting on utility payments, my club bills, etc., etc. And I have made it a policy after 2008, 2009, never ever to skip those payments. I prepay them so that I can avail of discounts. So wherever I get a discount, I will take it. It serves two purposes. Number one, I save money on these payments, which anyway have to be made. Number two, it takes away the pebble from my shoe so that I can run and climb mountains throughout the year. Now, many of these service providers like direct to home, cable TV networks, etc., web hosting, social media platforms, etc., actually give you deep discounts if you pay for the entire year upfront. They might even give you extra time. So, pay for 11 months, take the 12th month free, or pay for 12 months, take the 13th month free. I would grab them with both hands. Now, I'm also thinking of contacting our local friendly neighborhood vegetable and fruit seller. I'm told that these guys invariably have cash flow problems. So I'm going to make them an offer. I'm going to tell them I'm going to prepay my estimated bill based on my past billing. I'm going to prepay you for the next 3 months. You can keep deducting the bills of every week or every twice a week that I call vegetables for you from you. Give me a 10, 15, 20, 30% discount on XYZ items. Believe me, it works. I would have to negotiate, I agree, but I expect food inflation to go up. And any which way I can afford to get discounts so as to cut my cost of living, I am thinking of doing so. Most medical stores will give you anything between 15 and 20% discount on medicines. But try, if you're living in Mumbai, try buying from Dawa Bazaar. Dawa is medicines in Hindi, so it's a medical market where your discounts can surprisingly go as high as 40%, if not higher. Now, I don't even have to go there to buy these medicines. I call them on the phone. I make a payment upfront and they charge me 100 rupees depending on the weight of the medicines to send it to me via VFast or any other quick delivery courier who is at my doorstep within 60 minutes after the medicines have been paid for. Now, 40% is a huge amount. I have two super senior citizen parents. I got wife and kid. We are all wife and me are above 50. We do have medical bills that are substantial. So this is how I'm going to try and cut down my cost of living and yet not compromise with quality. Wherever I can, I will pay by credit card rather than digital wallets, mobile wallets. The reason being that my credit card company gives me a very liberal money spinner point method, which I can either swap for cash or I can redeem these points for purchases. Now, these mobile wallets don't really compete half as well. So, this is another way of blunting the inflationary blow. Secondly, you can time your purchases to festive seasons. Like for example, the Republic Day is coming up. You will then have the Holi festival coming up. You'll have March ending, which is a financial year ending, coming up. Almost every department store, every e-commerce site will give you sweetheart deals and discounts. Rather than succumb to temptation and buy shop a knee-jerk manner, plan your purchases, and hey, you can save another 20, 30, even 40, 50%. That's a smart way of buying things. Once all my utility and essential payments of insurance, etc., are prepaid, discounts availed, and I am relatively free mentally, I will then plunge into my trading regimen. Now, friends, I come to the broad strategy. Those of you who know me long enough know by now that I'm a trader rather than a delivery based investor in financial markets. Now, that I might just change after many, many years to a certain degree. Allow me to explain. So, on one hand, I take exposure in derivative segment in commodities, in equity indices, equity stocks. Of course, currency trading is now off. So, that is completely high risk, I admit. So, on one hand, I'm doing extremely high risk derivative leverage trades. On the other hand, I swear by sovereign guaranteed investments. I've been talking about bonds and other investment avenues that are completely backed by the President of India. So I think my risk is kind of balanced. Extremely high risk derivatives trading, almost zero risk sovereign guaranteed investments. So I'm going to try and add delivery based investments in equity in the current calendar year. Now, what is my choice? I made a video some months ago, you can watch that here, as to why indices are any day better than equity shares. The logic is explained there. I get a lot of feedback from a lot of wise guys. Hey, look at this SME. Look at this MSME. Look at this small cap stock, which is a 3-bagger and 5-bagger and 10-bagger. Can your index do that? Well, Mr. 5-bagger, how many of these 5-bagger stocks did you actually buy? At the end of the day, why is SEBI saying that more than 90% of participants in the market are losing? So you have to take a very nuanced approach. Now, this is why I think, like I said in that video, indices present a better way. Even Warren Buffett does that. If you were to invest money in a low cost index fund or an index ETF, which is passively managed, you don't need to fool around with the investment mix unless the composition and the weightages in the indices change, which is why the expense ratios are smaller compared to other equity actively managed funds, and the tracking error also is a lot more frugal. Now, there is another benefit to me as an investor in these index funds. Now, since I'm buying these index funds which are approved by brokers and exchanges as collateral, I can use these ETFs or index funds as margin pledge collateral. Now, as per the law, I can pay 50% of the margin money as cash or even FDs. Now, that is a damn good way to pay. If I was to give 50% of the margin as FD, on which I get a ballpark, say 6% interest per annum. Supposing you and me are keeping a crore as FDs as 50% collateral, that's 6 lakh rupees as interest per annum. The remaining 50% you keep index funds. Now, chances are, like I explained in the video, which is better, indices or stocks, there will be some gain on a year-on-year basis over a long period average of say 5, 8 or 10 years. Not only you stand a chance of beating the interest rates, but you're saving on the amount of margin that you're giving to the broker. So this is a big kicker, which is how you can increase your yield. Put half the money as fixed deposit, half the money as collateral from approved securities. The FD will earn you interest. The approved securities will give you a capital appreciation potential, and your yield on the trade, especially option writing, will be significantly higher. This is my game plan for 2025. There are a few things that you will have to keep in mind before you buy these index funds or especially ETFs. Buy after significant declines at established support areas as per technical analysis, statistical analysis, or screen reading analysis, or even fundamentals if you are a fundamental guy. Why buy and chase the price up when you can buy it at a somewhat lower prices after a fall has occurred, especially since you intend to keep them for at least 5, if not more, years. All right. So your downside tends to be capped. Now, another thing. Now, here again is why I told you that you need a minimum of 25, if not 50 lakh rupees prior to SEBI increasing the margin amounts. I have no magic wand like a whole lot of other people, far more intelligent than me, claim on social media that if you invest 15, 20, 50,000 rupees, you can earn 5, 10, 12,000 rupees per day. Hey, I'm sorry. I'm not that smart. I don't have any such magic wands for you. All I know is that you get a certain return on investment, let's call it yield, and you need to put in a substantial amount of money at realistic yield levels to run your house on your market trading activities. So you'll have to keep dry powder. Dry powder means spare cash even after you give collateral as index ETFs or index funds. Why? So that you can write deeply out of money calls to earn option premium, at the same time write deeply out of money puts. Now, since you're writing calls and puts together, like I explained in those two option specific videos, the exchange gives you a margin discount because you're long and you're short. Therefore, you're providing a smaller amount of risk to the exchange. All right. So you can keep earning extra income month after month provided your pockets are deep enough. That writing options deeply out of money strike prices is something I've explained in those videos. Please watch them. Now, if you're planning to write options on a daily, weekly, or monthly basis, don't forget to look at our daily, weekly, and monthly pivot levels that I provide free of cost on our Telegram channel. And at the same time, don't forget to watch this video in which I have explained how to use our pivot levels effectively to earn a higher amount of trading profits. Now, you would want to ask me, hey Vijay, which index funds or ETFs should I be buying? Now, like I said, due to SEBI regulations, I will desist from giving you specific names. I will not tell you buy this one. What I am going to do is the next best thing. In the description and the pinned comment below this video, I have enclosed a hyperlink to a search that I have done on the internet. The search has thrown up some names. Now, out of these names, use two primary criteria. If you know better, more, go ahead and do it. But the two criteria that you must have is the expense ratio of the ETF or the fund must be lower. That means they are charging less handling charges to the unit holder, and the tracking error is more investor friendly, which means it's deviating the least amount from the actual index itself. So it's giving you a true and honest return just like the index would. If you're able to do these two things out of the list of funds that I have provided, believe me, you don't need to pay any fees to anyone. You are your own boss. You know enough to take care of your money. Be your own boss. Now, friends, in this first part of the video for 2025, I'm now getting a little more specific. I'll get more and more specific in the next parts. So now I come to Bullion. I have good news and bad news for you. And the bad news is that inflation will be sticky and it will be possibly higher in 2025, particularly food inflation all over the world. That's something, like I told you, the Austrian School of Economic Theory experts would tell you it's a misery index. where food inflation is concerned, you and I are going to be a little more miserable than we were in 2024. Now, if you were to add rising cost of funds, you will know that as I said in my video about cost of funds here, paper assets or high risk asset prices tend to either fall or stagnate when cost of funds are rising. So on the one hand, your cost of living, thanks due to food inflation, will go up. On the other hand, returns on your paper assets might just fall, or they might give you smaller returns. And as it is, I told you in the case of Nifty and Bank Nifty, I told you that although there has been appreciation from October 2021, if you calculate the cost of carry and cost of funds, you're in the negative. So you're not going to be doing too well. Now that's the bad news. What's the good news? This is an ideal ground for gold and silver to go up. Plain and simple. I've made enough videos on bullion, where to buy them from, how to have it checked for purity, how not to get cheated, what is the price target for gold, and why bullion should be in your portfolio. I would go to the extent of saying that have 20, 25, even 30%, if not higher, as component weightage of bullion in your portfolio. Friends, I come to industrial or base metals. Now, nowhere in the world do markets move in a straight line as a trend, nor will metal prices. So there will be jagged ups and downs, peaks and troughs, peaks and valleys. Now, what's interesting to note is how the markets justify the stories that are invariably present in the market. In the last couple of years, I've learned something that's been very, very interesting and a learning experience for me. In the market, narratives, storytelling, and spin doctoring is what works extremely, extremely actively and aggressively. Before you ask yourself this question, hey, what about the truth? Just remember what Winston Churchill had said 3/4 of a century ago during World War II. A lie will travel halfway around the world before the truth can get out of bed and get its pants on. So, a lot of narratives, you've heard the super cycle theory in crude oil and natural gas, 200, 250, $300 a barrel for crude oil since 2021, which I have been debunking, of course. You heard about how inflation is going to be transitory. You've heard about why lumber, which is chopped wood, prices were justified at 600% during the COVID lockdown days. Were trees running out of style? No, they were not. Did we have to go to Mars to get wood from? No, it was not. So narratives, spin doctoring, and storytelling happens in the markets. So base metals, I don't think still will see super cycles in the markets, but I'll be very, very interested to know what stories are going to go and do the rounds, because that is what will tell me as to how long the effectiveness or the efficacies of these stories will last. Unfortunately, all these high decibel stories are propagated by non-market participants with nothing to lose. So you and me as real world traders have to take extra care of our money. That's why it makes it all the more important to understand the source of the narrative and what the narrative is all about. Currently, I'm hearing stories about copper becoming the next oil because of the artificial intelligence boom. You'll need far more computers. You'll need a whole lot of electricity to power those computers. And what's better than copper to conduct that electricity in cables? Therefore, copper is a multi-bagger and a subject of a super cycle. You have wars in Ukraine and Russia. You have war in Gaza. You have a lot of destruction of property. And at some point in time, all these wars will come to an end. Great deal of hopes are being pinned on Donald Trump to come out there and smoothen out these fires of war and escalate the peace process. So buildings will have to be remade. So you'll have aluminium, you have nickel, you have stainless steel, you have iron, you have copper that will come in demand, and therefore metals will have a super cycle. Fine. We've heard that before. Do me a favor. Do yourself a favor. Go back in time and see how many wars lasted more than 6 months or maybe even more than 1 year in the past. And when they ended, you've had wars in Eastern Europe, you've had wars in the Gulf before, you've had wars in the Middle East. Ask yourself what happened. And in this day and age of free charting on multiple free charting websites, ask yourself what happened to base metal prices when these conflicts ended. Were there super cycles? Remember what a super cycle is. A super cycle means no corrections, one sided price rise, and the price rising substantially, maybe even multiplying, which is very difficult for commodities. But hey, that's what I'm being told by the experts. If you ask me what's happening, I think none of these metal inventories are running out of the earth, and neither do we have to go to the moon or Mars to fetch these metals because they've run out. I've been telling you since months that Latin America, LATAM, which produces and is responsible for exporting majority of the global industrial metals complex, suffering from a huge amount of political and societal upheavals. They are up to here in debt, they are corrupt, they are inefficient, and as long as they have sovereign debt, they will be forced to sell metal. So, as long as these conditions exist, I don't think a super cycle is happening. Will there be a bull market? Yeah, sure. Like I said, no market in the world goes up in a straight line or falls in a straight line. There are always jagged movements. So there will be periods when these narratives and these stories will see prices being impacted by sentiments more than fundamentals. You should be ready for that. Since I don't expect a super cycle in these metals, I think higher levels, significantly short period of time when the price rise comes in, I expect resistance to cap the gains. Now I come to oil and gas. These markets will get a tad more volatile, and a tad is an understatement. You're going to see volatility go through the roof. Now, you on one hand are going to see new kids on the block like Guyana, Namibia, and Nigeria's Dangote refineries pumping supply in the oil market, which, according to me, and I have been proven right by the prices, the oil markets are oversupplied. So are gas markets. But hey, that's just me. You can basically also include capacity expansion in Libya. Kuwait and Saudi Arabia are basically expanding the output from the no man's land border wells like Wafra and Khafji. Saudi Arabia is cranking up output from its supergiant gas field at Jafurah, spending more than $110 billion to basically do so. The Abu Dhabi National Oil Company is cranking out its oil and gas output from its well in the Middle East. So you're going to have a whole lot of supply coming in from these guys, and that is not even including off the books ghost inventories which are not supposed to exist being sold in the high seas in unmarked tankers without any satellite transponders. Now, this black market oil supply will grow from Venezuela, from Iran, and in Russia, and these are not the exhaustive list of countries that sell in the ghost markets. So, these activities will require an oil and gas trader to have special skills. Skills to be able to collect human intelligence about who is delivering unmarked inventory and where. Also, open source intelligence about how many wells are upping or lowering their output and for how long. You, of course, will need screen reading and technical analysis skills as well. Do remember, oil and gas are widowmaker markets. These are not easy to trade unless you have special skills. Please avoid them. The echo chambers of bull markets and super cycle theories will obviously continue to chant, but hey, I have seen the decibel levels fall. They're tired, and they should be. They've been basically spinning this narrative of 200, 250, 300, even $350 US dollars per barrel of crude oil since end of 2021, if not earlier. So I can understand if they are a little exhausted and they want some rest. But believe me, they will continue to come back and do their stuff once ever so often. Also remember that of all markets in the financial and hard asset space, oil and gas are the most sensitive to the cost of fund theory. Now, this gets interesting. If you have taken my advice and studied Dick Token's work, whenever you see an average retail Joe get carried away by the echo chambers of the bull or super cycle markets and starts to pay a very heavy cost of carry and cost of funds, go out there and basically resort to theta decay. That's your cue. At least that's what yours truly will be doing in 2025. I want people to come out there and pay me high cost of funds. Friends, I'm concluding part 1 of this video here and will be releasing the next part very, very shortly. And I will delve deeper into segments like options and future strategy, sectors and how to play them in 2025, how the high frequency traders, artificial intelligence and algo traders will participate in the Indian markets coming from overseas in 2025. I will also share my strategies not just on trade initiation but also trading psychology. Do remember, in these 2 videos, I have told you about fearlessness in trading and also how to master your mind in the trading process, because at the end of the day, it is behavioral science that basically differentiates a trader from a losing trader to a winning trader. I thought earlier it was some empirical formulas, technical analysis, chart reading, etc., that resulted in segregation of losing and gaining traders. I'm now older and wiser. I think it's behavioral science. So I'll be sharing those aspects of trading in my videos and cutting edge techniques that real world traders do deploy to improve our odds of success. Now, do remember that SEBI's findings say that over 90% of FNO traders lose money. You and me, as real world traders, I presume that you're watching my video as a real world trader and who is either profitable or aims to be profitable, are the elite under 10% of the traders, and be proud about what we do. But we cannot afford to rest on our laurels. We will have to try extra hard in 2025 to remain profitable from the overseas competition that is going to come there and raise the bar. So we'll have to up our skill, we'll have to up our understanding of the market, basically try and survive and thrive in this market. A humble request here: we do not provide any commercial services as a matter of principle. All we need you to do is to share our labor of love and our videos with your entire social media contact list, friends, family, and social media platforms, so as to enable us to reach out to a wider audience. And before I end this video, a reminder to subscribe to our new YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know how my videos help you to trade better. I thank you for your patience. I look forward to meeting you in part 2 of this video. Take care. Bye-bye.